Hey, it's Rav. Welcome to the Everyday Investor TV show. This show is designed to help us grow our money. You see, the challenge often is that we take our precious time, we go to work, and if we do go to work, we are blessed. We receive a paycheck in order to eat. Let me say that again. We take our time, we go to work, we make money so that we can provide for our family. But imagine a life where money could make you money. You could work a little less if you wanted to, and then you could spend that time with family, friends, engage in a purpose greater than yourself. Every single week, I have an expert guest teaching their vehicle of investment so that you could be nurtured, so that perhaps if you wanted to do the same thing, you could. We are so grateful for you to be able to watch the show. Don't go anywhere. We'll be right back. Coming up, we're talking to our good friend Kyle Ford, and he's teaching us how we can make money investing in a fund.
What is a mortgage trust? By definition, a mortgage trust or a fund is an alternative investing option that consists of a diversified pool of mortgages that are secured by residential and commercial properties.
Did you know that if you're selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, zero commission. Head over to our website, everydayinvestor.com, and find out more.
Are you a debtor, saver, or wealth creator? Most Canadians in the middle class are debtors or savers. They go into debt, pay it off, go into debt, pay it off, go into debt, pay it off, and they end up with zero. Or the saver thinks they're getting ahead. They save, pay cash, save, pay cash, save, pay cash. But they still end up at zero. Now, what do the wealthy people do? Well, the wealthy people are not debtors and they're not savers, they're wealth creators. And a wealth creator wants to stay on that compound interest curve for the rest of their lives, and when they need money, they're gonna borrow against that asset. They're gonna borrow and pay it back, borrow and pay it back, borrow, pay it back. But at the end of the day, instead of ending up at zero, they end up here. To learn how to be a wealth creator, check out controllandcompound.com/everydayinvestor.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rav. A few years ago, I learned how to trade stock options by taking the Theta trading course. My son, my friends, myself, all of us benefited immensely by applying their strategies, and I want you to have that same benefit by taking their course as well. I'm not receiving any monetary benefit whatsoever by telling you this. It's just that, as you know, I believe that knowledge mitigates risk. Visit their site to find out more. Hey, it's Rav. Welcome back to Everyday Investor. As mentioned before, we have Kyle Ford teaching us how to make money investing in a fund. Instead of me being here interviewing him, he's actually going to come right here into studio in just a second, and he's going to teach you firsthand why he's transitioned from the traditional private lending to starting this fund for people like you and I being able to enjoy some very healthy returns. Without further ado, Kyle Ford.
Hey, this is Kyle Ford, and I'm very excited to introduce to you the CapGap Mortgage Trust. This is a private lending solution that myself and colleagues and team have spent almost 2 years creating, perfecting, and we are extremely excited to bring it to market. The CapGap Mortgage Trust is solving for the capital gap in the real estate lending market and helping real estate investors grow and scale their portfolios, investors lend and grow their wealth. Before we do any investing, we have to start with the legal disclaimer. And with a general disclaimer, trust units are available to qualified investors on a private placement basis only via the offering memorandum. Before investing, Always get independent legal advice, accounting advice, and make sure to read in detail all documents. Units in the fund are available for investment via a signed subscription agreement through Atlas One, a registered exempt market dealer. What is a mortgage trust? By definition, a mortgage trust or a fund is an alternative investing option that consists of a diversified pool of mortgages that are secured by residential and commercial properties. The objective of a mortgage trust is to provide superior yields while generating consistent, predictable returns for investors while preserving the underlying capital. As a result, investors can receive distributions based on the overall income of all mortgages within the trust. What are the differences between a REIT, a MIC, and an MFT? This is something that we spent a lot of time on when creating the CapGap Mortgage Trust. As mortgage lenders and investors, most people would form a MIC, and I'll explain a little bit about why we went the direction we did. To start, what is a REIT? The primary business of a REIT is to buy, own, and manage income-producing properties. Profitability can be affected by vacancy, interest rate increases, and REITs are bound to strict guidelines regarding income generated and distributions. A MIC is a mortgage investment corporation. And what a MIC does is lends on mortgages. MIC funds are placed in a pool of secured private mortgages on property, however, cannot manage or develop a property like a REIT. Also, 50% of its assets must be invested in residential mortgages only, typically at a lower loan-to-value ratio. When we first created to create this lending tool, a MIC was actually the product that we set out to create. However, as real estate investors, we love lending on apartment buildings. And an apartment building over 4 units is considered commercial, which means if we created a MIC, we would have to cap the amount of lending we do on apartment buildings. As a fund manager and as a private lender and real estate investor myself, I want to be able to lend on apartment buildings without that cap. So what we did is we created a mortgage trust. Now, what is a mortgage trust? The underlying structure is considered a mutual fund trust, legally structured as a mutual fund, but have advantages over a MIC. Similar to a REIT, underlying assets secured against property in the form of mortgages, but unlike a MIC, the MFT can hold real estate over the long term in trust. What does that mean? In the event of an economic downturn, bankruptcy, foreclosure, or power of sale, mortgage trusts are able to seize the underlying asset and can choose to rent, hold, or sell it. This is a built-in defense mechanism for our investors that allows us to physically own the property and recover an asset in the event of economic turmoil. Mortgage trusts are not limited in the types of mortgages that they can be invested in. This means we can lend over 50% of our funds on apartment buildings. Why a mortgage trust? After my years of successfully working in the mortgage business and as active real estate investors ourselves with our own established portfolios, we recognize that there is a gap in the capital market. Borrowers may have hit their maximum borrowing capacity with their current lenders, and they may now be looking to scale their portfolio to larger commercial buildings and or acquiring more properties. Our goal, to fill this part of the market for our borrowers by creating an investment vehicle for our investors that delivers a diversified offering of varying loan-to-value mortgages, providing superior yields to the bond market, and generating consistent, predictable returns while preserving your underlying capital. What is the CapGap edge? After years of combined mortgage industry background and knowledge as active real estate investors, licensed mortgage professionals, and as mortgage originators and administrators of multiple private mortgages. We rigorous screening to qualify borrowers that take into consideration the 5 C's of credit and other underwriting criteria. Past experience that has laid the foundation to originate, structure mortgages tailored for fellow real estate investors as they acquire and grow their portfolio. In addition to that, the CapGap edge comes from our existing portfolio of mortgages. When most people set out to start a mortgage fund, trust, MIC, or REIT, what they need to do is, first of all, do a presentation like you're seeing today that attracts investors. Then take on the money. Then tell borrowers the money is available, and then place the money. What that means is it could be 3 to 6 months before your funds are actually invested. The key edge to what we do is we have a pool and a backlog of borrowers and open mortgages waiting for payout, which it means on a monthly intake as we're taking in money, we're immediately placing those funds into active mortgages and generating a return right away. Our offering, what are we offering? 3 different portfolio types with different return, risk, and characteristics through limited partnerships or LP units. Class A are targeting returns by lending on mortgages of up to 80% loan to value. And in Class A, we will only be lending on first position mortgages. Class B, target returns of 11% by lending on mortgages of up to 90% loan to value in both first and second position. And Class C, targeted returns of 14% by lending on mortgages of up to 100% of the as-is, but more importantly, not to exceed 80% of the as-complete. This is a construction financing arm of our fund and designed to lend on value-add improving properties. So those are the 3 unit classes. And one of the fundamental things with our fund is we are looking for a 3-year commitment from our investors. If you need your funds out prior to that, that is absolutely not an issue. We have that is built into our program. However, there are some redemption rights. And in the first year, it will be a 3% reduction. In the second year, a 2% reduction. Third year, 1% reduction. And after 3 years, there's no penalty or fee associated with redeeming your funds. Some of the particulars of the fund. Units in the trust are $10 each with an initial investment of $10,000 minimum for qualified investors through our exempt market dealer, Atlas One. We are registered plan eligible through Olympia Trust. So if you're looking to invest your registered funds, we are able to accommodate those. We are offering an introductory threshold of $3,000. This isn't for a particular time period and can be revoked at any time, but the standard minimum will be $10,000. As a part of our launch, we're accepting as little as $3,000. One of the things that we are very excited about is we are DRIP eligible, which means as you're generating your returns, you're going to be able to reinvest them right away for maximum compounding. You are able to invest up to a minimum of $1,000 after you've done the initial tranche. Our investments will be diversified across a range of mortgages and borrowers who are primarily seasoned real estate investors, many of whom currently have a portfolio of investment properties. Income from the pool of mortgages is distributed to all investors based on the number of units held in the trust and the amount they invest in the trust. Taxes income to the investor and T5 slips to be generated in the next February from the previous year, as well as all of our distributions will be made monthly. Investors share the risk of associated with the mortgages in the pool, as opposed to current direct private lending. If one mortgage goes bad and you're in that one mortgage, your interest is at risk, your principal is at risk. In this model, we are diversified across a pool of funds. Withdrawals of some or all of your capital can be made, but are subject to the trust liquidity and proper notice. Funds will be continuously raised through subscribers, from subscribers through Atlas One Digital Securities, the platform used to purchase the units in the investment. The trustees of CapGap, we are the ones who are ultimately responsible for the decisions and the investments that are made. The combined experience is longer than my lifetime, but in order for you to get to know us a little bit, myself, Kyle Ford, Anna Scott, Joe Ward, and Steve Aho. Just a little bit about us. I've been in the financial services for over a decade, previously a financial advisor, and now in the mortgage business. I built one of the top teams in Canada. Mrs. Anna Scott, with over 30 years of corporate compliance and privacy. She's got a knack for the details and experienced, savvy investor herself. Mr. Joe Ward has been practicing law for longer than I've been alive. As a very seasoned real estate investor and private lender, he's also our in-house counsel. And Mr. Steve Aho, with over 40 years of IT experience, as well as a successful mortgage agent. He is also a seasoned private lender as well. So the trustee's role in the fund is to oversee investment decisions and make sure that we are able to make sure that the funds that we are lending on and the loans that we are lending on are suitable and in line with our offering memorandum. The CapGap value proposition. We're offering professional management. We will source and acquire the mortgages as well as take care of the administration and ongoing management of the mortgages on your behalf throughout their life cycle. Participation in the real estate market. Our funds Our fund offers a means to invest in properties through mortgages that are secured against property, protected by well-defined power of sale and foreclosure laws in Canada. Competitive income through regular distributions. The level of yield may vary depending on the performance of the trust. We are registered funds eligible and the tax treatment. Our mortgage trust is 100% available for all types of registered accounts. What we further bring to the table beyond that, and I mentioned this a little bit earlier, if you're doing individual direct private lending, you're lending on one specific property on one specific loan. Our fund will enable a broader level of diversification in the investor's portfolio from traditional equity and fixed income mix. This can be attractive to investors with smaller positions, as trusts can enable investors together with other pooled funds to participate across various borrowers in different geographic locations, property sectors, and in different project stages as well as loan sizes. Risk management. Security in the form of a mortgage charge that is legally registered against each property in our portfolio with a defined interest rate for a specific period of time. Just to reiterate here, everything that we lend our funds on will be secured as a mortgage position with a registered loan on the property. There will be no promissory notes, no general securities, no napkins, IOUs, or any type of cool handshake I haven't heard of yet. This will always be a registered, secured mortgage position. Investors can expect a predictable stream of income. The underlying mortgage's assets are obligated to maintain ongoing payments to the mortgage. As I mentioned earlier, we have an established pool of existing borrowers. This is one of our competitive advantages here. Not only do we have new opportunities coming down the pipeline, we have an established pool of borrowers. And as conventional mortgage rates rise and increasing regulations are being placed on traditional lenders, alternative financing is becoming more favorable. CapGap, the fund to choose. As I mentioned, prior experience in the private mortgage market makes us well placed to make calculated investment decisions in your best interest. Proactive risk management. We have the ability to identify risks and proactively manage their impact on returns. Secured investments that offer stable income, diversified lending with no downtime between mortgages. Customer service and reporting. We will be providing communication about the trust, the fund's performance, and your investment. Now, I know you have a lot of questions, so stay tuned and I'll answer them when we get back after the break.
Did you know that if you're selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, zero commission. Head over to our website, everydayinvestor.com, and find out more.
Hi, it's Darren Mitchell from Control and Compound. If you're a real estate investor or business owner, you know the cookie cutter approach to financial planning doesn't work for you. You've got to be in control of your money. You've got to save and store your money differently than other people. At Control and Compound, we are the wealth coaches for real estate investors and business owners. We show you how to save your money, grow your money tax-free, multiply your money tax-free, and spend it tax-free. To learn more, please check us out at controlandcompound.com/everydayinvestor, where viewers of this show get a complimentary education session.
Hi, it's Steve Aho at Canada's Mortgage Choice. On the drive to the studio this morning, I got a call from my brother. My brother has 7 properties in a community, and his question was, what do I do about interest rates? Do I lock in? Do I keep them variable? I said, well, it depends. And your situation is likely going to be the same, and it will depend because everybody's scenario is different. If you want some help with some analysis on your portfolio of properties, not knowing whether you should lock in or continue with variable rates, give me a call at Canada's Mortgage Choice.
Welcome back, and now we're going to answer some of your questions. Can you invest using a corporation? Absolutely. It is available to invest via cash, registered accounts, or corporations. It will just be subject to suitability requirements of that company, but absolutely, we are absolutely able to work with corporations. How does CapGap make money? As mentioned earlier, our target returns are 8, 11, and 14. Our target borrowing rates will be at least 1% above that. That is our built-in administration fee to handle the soft costs and hard costs around running the fund. In addition to that, we will be charging the borrower an additional fee in terms of loan origination. So from an investor perspective, our targeted returns that we spoke of are net of fees, and any additional fees on top of that are subject to the borrower. Can targeted returns be higher or lower than projected? A targeted return is exactly that. We cannot guarantee the rate of return that we provide to our lenders, though we have a great track record of being able to deliver this within our existing models. In terms of higher returns, this is an income fund, which means we are not expecting large equity swings or much higher or lower than the targeted returns. What our goal as the CapGap trustees is, and myself as the fund manager, is to consistently and stably deliver the projected targeted returns. So as an investor, you can expect a stable income stream, not big swings. What is driving the targeted return, the higher targeted return in Class C? Class C is our construction fund. This is lending at an aggressive loan to value, and by definition is our highest leverage, highest risk fund. What we are doing is lending on future value. So for example, a value add project where somebody is doing strategic renovations, we are doing the construction draw mortgage, allowing them to exceed the as-is value, lending on the future. How did we come up with a 3-year minimum term? Many funds in similar type vehicles request a 5-year minimum commitment. In our current direct lending model, we offer a 1-year commitment. We knew in terms of efficiencies and being able to deliver this, we needed a longer commitment than our current model, but didn't want our investors to commit to 5 years. We felt 3 years was a number that gave a balance in terms of efficiency and management without too long of an expectation and timeline for the lenders. Where are we lending the mortgages? Our fund is Canadian only and will not be lending outside of country. Though our longer term goal is to lend across the country, in the infancy of our lending, we are going to be focusing on within 3 to 4 hours of the GTA, the Greater Toronto Area. Can the CapGap team borrow from the fund? Absolutely. We are investors too, and just like in the direct private lending model, we have the ability to borrow. What's most important is that we are subject to the same scrutiny as any other borrower, and though in many of our loans, we only need the sign off of 2 trustees. If one of the trustees is borrowing, all 3 other trustees must sign off on the loan. Can you split your funds between A, B, and C? Absolutely, subject to suitability of the fund class and your personal risk tolerance. You absolutely have the ability to separate your investment into different fund classes. Can your monthly distributions be split between reinvestment and withdrawal? Absolutely. If you're looking to reinvest your fund, a portion of your fund and take a little bit as cash flow or income, that is absolutely at your discretion. We ask as the team that that's not changed on a monthly basis for administration congestion, but absolutely, if you'd like to take a monthly distribution for a significant amount of time, then split it, or just keep it, reinvest it, we're absolutely open to that. How are your returns taxed? This is taxed as interest income with annual T5 slips being reported from the fund. How do you invest? Absolutely. Reach out to info@CapGap MFT, our website, capgapmft.com, or through Atlas One Digital Securities. We're looking forward to working with you. Are there any qualifications that you need to meet to invest? There will be suitability requirements as different loan limitations depending on your investor status. Now that I've had a chance to answer your questions, I want to answer one thing that comes up the most. Why would I do this over the current direct private lending model? And the answer is both businesses are alive and well and will be continually to be offered. The benefits of the fund versus individual direct private lending: the fund offers no downtime between deals. In individual direct private lending, you do a loan, it pays back, you wait for a new one, you vet a new one, you put it back out, and there's time between deals. This can also make it a little bit less passive. In the fund model, it's set it and forget it. You put your money in, sign once, deposit once, and expect monthly distributions. The benefit to the direct private lending model is you get to pick your deal. So you get to lend on 123 Main Street. The downside to that, though, is if that deal goes into default power of sale, 100% of your funds are at risk. The interest may stop completely until the power of sale is complete. In the fund model, if one deal were to go bad or sideways, other deals would still be paying their monthly cash flow, and though you may see a small decrease in interest, your overall return is still being produced. The other benefit to the fund model versus the direct private lending is the fees associated with registered accounts are much less expensive in the fund model versus the direct private lending. In direct private lending, you're looking at approximately $500 per year per account. With the fund model, $75 one-time fee. The other main benefit that I mentioned earlier is the dripping of returns. In individual direct private lending, your monthly payments have to sit there and build up before they can be reinvested. In the fund model, your monthly distribution is being invested right away, helping you generate a compound return. Though both options are going to be available for a long time, for the foreseeable future, there's not one versus the other, one better than the other. It's just about providing options to our investors to make sure they have the ability to do what's best for them. As always, if you have any questions on this stuff, don't hesitate to reach out to myself, team, and CapGap.
Man, that was awesome. Kyle is a wealth of knowledge. For more information, make sure you reach out to the information that's on the screen, and we'll see you next week. Same place, same time. Honey, I love you. I'll be home soon. Bye, everyone.
Hi, it's Darren Mitchell from Control and Compound. If you're a real estate investor or business owner, you know the cookie cutter approach to financial planning doesn't work for you. You've got to be in control of your money. You've got to save and store your money differently than other people. At Control and Compound, we are the wealth coaches for real estate investors and business owners. We show you how to save your money, grow your money tax-free, multiply your money tax-free, and spend it tax-free. To learn more, please check us out at controlandcompound.com/everydayinvestor, where viewers of this show get a complimentary education session.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey everyone, my name is Danny and this is my beautiful wife, Jillian. Just like you, we want to have success in our life and our family, but also we want to make a difference in this world.
A couple of years ago, with the encouragement and support of Rav, my husband decided to build Oasis Home for Kids. It's a loving refuge for orphans and abandoned children in Haiti. I've been blown away by what's been done in the lives of these poor kids in such a short period of time. Haiti is the poorest country of our hemisphere and they need our help now.
Indeed, Haiti's facing a serious humanitarian crisis. Many live in extreme poverty. More than 50% of the kids do not attend school and have no hope. Many orphans and abandoned kids can be found on the streets.
How can you help? $1 a day will make a big difference in the life of a child. With just $1 a day, we can provide quality education and a meal for that child who would have no chance otherwise to learn how to read and to write.
A simple act of love is the most powerful answer to complex problems. I'm so grateful for Rav's support from the beginning. We thank you in advance for your generosity. Now, together, let's change the world.
Learn more about our work by visiting our website. Thank you.
Merci.